Back to the Value Investors Club. I'm your host, Timo Wunderlich. Let's get right into it with VIC Readings, the format where we look at the best of the best value investment recommendations by the best of the best value investors out there. Today we have the Buckle Inc., ticker is BKE. Price at the point of filing is $40. I'm really excited for this write-up because I actually saw the Buckle before on the Magic Formula, and I looked at its fundamentals on Guru Focus, and it looked really good. And so I'm excited to read it. Please write down in the comments below if you have invested, will invest, or why not into the Buckle, and if you have read about it before or heard about it before and what you think of it. This is not a recommendation, not advice. Please do your own diligence before investing into anything, and let's get right into it. Summary: the Buckle, the company, or BKE, see Exhibit 1, is a fast fashion retailer of medium to better priced casual apparel, footwear, and accessories for 15 to 30-year-old men and women. Buckle markets a wide selection of brand names and private label casual apparel. Denim is a significant contributor to total sales, 39.6% of fiscal 2021 net sales, and is a key to the company's merchandising strategy. At the end of the 2021 fiscal year, the company operated 440 retail stores, predominantly in shopping malls in 42 states. The company headquarters and distribution centers are in Kearney, Nebraska. It was founded in 1948 by the current chairman's father. BKE went public in 1992. By the current chairman's father? That is interesting. So, probably there's a lot of insider ownership, I hope. The company emphasizes personalized attention to its guests, customers, and provides individual customer services such as free alterations, layaway services, free gift packaging, personalized stylist services, a guest loyalty program, and the Buckle private label credit card. A majority of the company's store managers, district managers, and executive management team are live Buckle salespeople, including President and CEO Dennis Nelson and Chairman Daniel Hirschfeld. MESSRS, I don't know what that stands for. Nelson, 72 years old. Hirschfeld, 80, and key insiders collectively own over 40% of the outstanding shares. That's what I meant, but that's really a lot, 40%. Okay, but better than institutional. Over the past 15 years, Mr. Hirschfeld has sold more than 25% of his shares, but still controls 33%. Why did he do that? Although the board pays and promotes talent from within, there's an unclear succession plan that raises questions on BKE's ongoing ability to operate in such a shareholder-friendly manner, exacerbated by the fact that no other named executive owns greater than 0.5%, more than 50 basis points of the company's shares. See Exhibit 2. At this point in the company's life cycle, it is critical that the board ensures knowledge transfer to younger executives. Unfortunately, without proper share ownership incentives, cultural disruption might be imminent. The board might be forced to recruit its CEO, COO talent externally. One of the company's strong investments themes has been its rare mix of owner/managers who understand shareholder value. BKE has averaged EBIT margins of 15.9%, 18.1%, and 19.4% for the most recent 30-year, 20-year, and 10-year periods. Over the last 10 years, margins have been around 20%. The latest LTM EBIT margins are above 25%, see Exhibit 13, which is in an all-time high in the company's operating history. We note that EBIT margins have been volatile for the last 10 years, rising to 23% in fiscal 2014, then subsequently falling to a low of 13% in fiscal 2019, then rising vigorously again to 25% in the second quarter of fiscal 2022. During this period, the company kept employee store compensation levels steady as it increased its online fulfillment efforts, targeted store/online advertising campaigns, increased unit prices, and negotiated better vendor pricing. This is carefully seen with gross margins, excluding store occupancy costs, trends over the same 10-year period, as gross product margins remained consistent at 50%, but then rose sharply to 59% in the last 4 years. With a total enterprise value of $1.62 billion, we estimate that the market is pricing BKE at a 5.0x EBITDA multiple and 14% EBIT margins. What do you mean you estimate? Historically, the company has traded at 8x EV EBIT versus luxury and big box retailers that historically trade at 14.2x and 10.7x EV EBIT multiples. This discount to peer multiples is a result of the company's anemic 5 to 10% sales and earnings growth over the last 30 years. Rather than expand through acquisitions or debt issuance versus peers, the company has instead targeted 20% unlevered equity returns and redistributed cash back to investors. I like that. Profitability over growth seems to be the theme since the 1980s. In extremely competitive apparel, it is best to pick spots and focus on profitability. The best retail comparison might be See's Candy Shops Inc. See's, owned by Warren Buffett, Berkshire Hathaway, BRKA. See's produces boxed chocolates and other confectionery products with an emphasis on quality and distinctiveness in two large kitchens in Los Angeles and South San Francisco, in a facility in Burlingame, California. See's operates 250 retail stores located in California and western states, as well as over 225 seasonal locations. At the 2019 Berkshire annual shareholder meeting, Buffett said about See's, "We put $25 million into it, and it's given us over $2 billion of pre-tax income. Well over $2 billion. The goal of Seas has not been the biggest or to cater to everyone, but to grow its niche and limit any capital investments that would cannibalize or distract from its core high RIC business." BKE seems to have a similar goal. Since 1999, BKE has returned 2.6 billion to investors in the form of dividends and share buybacks. From a total return, BKE outperformed the S&P 500 significantly. Therefore, as a result, we recommend purchasing the stock at or below $25 per share, which gets closer to BKE's historical low EBIT multiples of 3.5x. Wait, didn't they file this with with a share price of 40? Okay, so it's an overall idea when the market gives us a lower price than to buy. Okay, I get it. Which gets closer to BKE's historical low EBIT multiples of 3.5x. We believe BKE's fundamental characteristics at our recommendation follow preference of buying: number one, companies with a demonstrated consistent earnings power. Number two, businesses earning good returns on equity while employing little or no debt. Number three, exceptional management in place. Number four, simple businesses. And five, a fair price. I like these. I believe in them too. BKE appears to fit on all accounts. The corporate office is in Kearney, Nebraska. Company history. Buckle began as a men's clothing store in 1948 in Kearney, Nebraska, pronounced Kearney, and now has stores across in 42 states. The first store was founded by David Hirschfeld and operated under the name Mills Clothing. His son, Dan, took over the operations in 1965. In 1967, a second store was purchased and operated under the name Brass Buckle. At that point, the company began selling more casual men's clothing, and by the early 1970s, Brass Buckle had developed into a denim based store. In 1977, the company introduced women's apparel and has since evolved into its current incarnation. Brass Buckle changed its name in 1991 to The Buckle, and in 1992, the company went public on the NASDAQ and traded as BKLE at $2 per share split adjusted. In 1997, the Buckle moved to the New York Stock Exchange, where it now trades under the symbol BKE. Throughout the years, many changes have occurred in fashion, retail, and within the company. However, BKE management believes one constant has driven Buckle's success: its mission to create the most enjoyable shopping experience possible for our guests. The Buckle management team has a long history with the company. As mentioned, Dan Hirschfeld has been with the company since 1965 and leads the company as chairman of the board. Dennis Nelson is the president and chief executive officer and has been with the company for over 30 years. Mr. Nelson began as a part-time salesman while he was a college student and continued full-time after graduation. He has helped lead the company to over 440 stores and is actively involved in all phases of the company's operations. Carrie Smith, Vice President of Sales, has been with the company for 25 years. Individuals and insiders currently own 43% of the company. Competitive strengths and a company overview. The Buckle Inc. is a retailer of medium to better priced casual apparel, footwear, and accessories for 15 to 30-year-old men and women. The majority of the company's central office functions, including purchasing, pricing, accounting, advertising, and distribution, are controlled from its headquarters and distribution center in Kearney, Nebraska. As of January 29, 2022, the company had approximately 8,300 employees, called teammates, approximately 2,800 of whom were full time. Buckle operates like a family run business, and the majority of the management team, from store managers to senior management, began their career at Buckle at the sales floor. I like that. This gives the company a unique perspective on the business, as well as a sense of loyalty and culture that is missing at many of its direct competitors. The company emphasizes personalized attention to its guests, customers, and provides individual customer services such as free alterations, free gift wrapping, layaways, and frequent shopper program, the Buckle Primo card, and the Buckle private label credit card. The company has an executive vice president of stores, a senior vice president of sales, three vice presidents of sales, four regional managers, 22 district managers, and 76 area managers. Certain district managers and all area managers also serve as managers of their home base store. In general, each store has one manager, one or two assistant managers, one to three additional full time salespeople, and up to 20 part time salespeople. Most stores have peak levels of staff during the back to school and holiday seasons. Almost every location also employs an alterations person. I wonder if they actually have somewhat of a mode, because the only thing I'm seeing yet is like these credit cards or these Buckle Primo cards to keep to keep customers loyal. But I don't know if that really is a mode. I would say so, but let's see. Maybe there comes more. Buckle markets a wide selection of brand names and private label casual apparel. Denim is a significant contributor to sales, 39.6% of fiscal 2021 net sales, see Exhibit 4, and is a key to the company's merchandising strategy. The company believes it attracts customers with its wide selection of branded and private label denim and a wide variety of fits, finishes, and styles. Tops are also significant contributors to total sales, 30.2% of fiscal 2021 net sales. The company strives to provide a continual changing selection of the latest casual fast fashions. Wait, are they actually producing the clothes as well, or are they? Okay, I think that they're right about that now. Um, Brand name merchandise accounted for approximately 57% of the company's sales during fiscal 2021. The remaining balance is comprised of private label merchandise. The company currently offers denim from brands such as Miss Me, Rock, Revival, Can, Bridge by Glee or Gly, Flying Monkey, Levi's, Preem, Smoke Rice, Vervet, and Wrangler. Other brands include Hurley, Billabong, Affliction, American Fighter, Sullen, Howitzer, Oakley, Fox, RVCA, Ariat, Seven Diamonds, Nixon, Free People, Z Supply, Salt Life, White Crow, Brew City, Modish, Rebel, HYFVE, Versace, American Highway, 8X, Chemis Ranch, Sorrel, Hey Dude, Steve Madden, Dolce Vita, Saks, Stans, Pura Vida, Ray-Ban, Wanakome, Guess, Fossil, Brixton, Dr. Martin, Very G, Birkenstock, Bed Stew, and G-Shock. The company has an experienced buying team, which contributes significantly to the company's success by enabling it to react quickly to changes in fashion and by providing extensive knowledge of sources for both branded and private label goods. The company purchases products from manufacturers within the United States as well as from agents who source goods from foreign manufacturers. Buckle has not experienced any material difficulties with merchandise manufactured in foreign countries. The company does not have long term or exclusive contracts with any brand name manufacturer, private label manufacturer, or supplier. In fiscal 2021, Axis Denim, which produces private label denim for the company, accounted for 15.6% of net sales. No other vendor accounted for more than 10% of the company's net sales. That is great. We don't want suppliers to have too much power. Expansion strategy. Buckle has grown its store base consistently at approximately a 6% CAGR since 1992 and 2% over the last 10 years. The company's criteria when considering a particular location for expansion include number one, market area, including proximity to existing markets to capitalize on name recognition. Number two, trade area, population, number, average age, and college population. Uh, College population. Oh, okay, 15 to 30. Okay, yeah. Third, economic vitality of market area. Fourth, a mall location, anchor tenants, tenant mix, and average sales per square foot. Fifth, available location within a mall, a square footage, storefront width, and a facility of using the current store design. Six, availability of experienced management personnel for the market. Seven, cost of rent, including minimum rent, common area, and extra charges. Eight, estimated construction costs, including landlord chargebacks and tenant allowances. Total of numbers per store in the last 22 years. In 2001, there were 3 stores closed, 24 stores open. And at the end of the year, there were 295 stores in total open. And in 2022, there were 442 stores open in total, and new stores opened and 1 store closed. Hmm. 20-year growth. Oh, yeah, that's what he said. 20-year growth in opened, a new opened source is 6.3%, but close is 3.4%. Oh no, both are minus, negative. Wait, what? How can that be? That doesn't make much sense, right? Because there are more stores now than before. Wait, what? That's weird. I don't know. I'm confused. As of August 2022, the company operated 440 retail stores in 42 states. 85% of stores are in shopping malls. The average store is approximately 5,000 square feet, of which the company estimates an average of 80% is selling space. And stores range in size from 2,900 square feet to 8,475 square feet. The company generally seeks sites of 4,250 to 5,000 square feet for its stores with 17 to 18% of its store fleet in smaller markets with communities of 50,000 or less. BKE enjoys industry leading rent, which some analysts estimate to be $28 per square foot and at a 9.1% of sales. But store productivity in terms of sales per square foot, SSF, of $468 and revenue per store of 2.43 million have remained below industry medians, particularly revenue per store, highlighting the fierce competitiveness of fast fashion youth apparel. The company completed an 82,200 square foot expansion to its corporate headquarters facility during fiscal 2005, which housed its online fulfillment and customer services center, as well as its supplies and return to vendor departments. During fiscal 2010, the company completed the construction of a $25 million, 240,000 square foot distribution center in Kearney, Nebraska. The company transitioned to the new distribution center in September 2010, and the new facility is currently the company's only operating store distribution center. The company also owns 2 additional facilities as a part of its home office campus in Kearney, Nebraska, one of which was completed during the first quarter of fiscal 2015. So if I got that right, if I got if I got that right, um, that BKE has its stores in smaller markets with communities of 50,000 or less. So that might be their competitive advantage. There's nobody else, right? BKE does not have multiple layers of management, and the merchants are empowered to make decisions. A merchant's ability to quickly shift purchasing dollars into emerging brands and or categories has helped bolster BKE's success. Positives: strong, experienced management. The Buckle's executive team has a conservative management style that should allow for less volatile performance. The team is careful with how it opens new stores, makes decisions about its assortment, and manages its balance sheet. The company has no debt and favors special dividends to buybacks. Many of the top executives in the company have been with the Buckle for the majority of all of their careers. This leads them to think of themselves as stewards of the company to a greater degree potential than executives at many other retailers. The company places great importance on educating quality personnel. In addition to sharing career opportunities with current Buckle employees, the company also recruits interns and management trainees from college campuses. A majority of the company's store managers, all of its area and district managers, and most of its executive management team are former salespeople, including President and CEO Dennis Nelson and Chairman Daniel Hirschfeld. Recognizing talent and promoting managers from within allows the company to build a solid foundation for management. The buying team is led by the vice president of women's merchandising and vice president of men's merchandising, who have over 63 years of combined experience within the company. Management believes the experience and leadership within the buying team contribute significantly to the company's success by enabling the buying team to react quickly to changes in fast fashion and by providing extensive knowledge of sources for both branded and private label goods. Capitalizing on brand trends. Buckle's success, however, is in part due to its ability to effectively brand assort. Branded products represent 57% of 2021 fiscal year sales. In the mid 2000s, merchants at Buckle successfully began adding new brands to the collection, which resulted in an updated look and style for the company. The core customer has responded favorably to the evolution beyond surf brands. Not only has Buckle effectively identified emerging brands ahead of many competitors, but the company has also partnered with many of these brands to develop exclusive products for its stores. We believe this has solidified Buckle's relationship with brand loyal shoppers and enabled the company to offer a unique assortment. The company's brand mix changes regularly now to support current trends in the market. The company continually strives to offer brands that are currently popular with its customers, and therefore the company's suppliers and purchases from specific vendors may vary significantly from year to year. As a result, Buckle's long term outlook is not necessarily tied to current fast fashion trends, or that recent success was simply a result of favorable fashion trends. Instead, Buckle has proven it can adapt its merchandising strategy to embrace emerging markets and the latest trends. Buckle has broken out its top performing brands in each year's annual report, noting any individual brands representing over 10% of total sales for the company. These brands are listed each year in order of total sales from greatest to, to least. Exhibit 10 illustrates BKE's ability to rotate seamlessly from brand to brand depending on what it is most popular with the core customer or guests. For example, following the life cycles of Fossil and Miss Me from their first introductions in 1999 for Fossil and 2008 for Miss Me, to the rise of each brand as a percent of sales to the peak, 2002, 2003 for Fossil and 2014 for Miss Me, followed by their decline in subsequent years, demonstrates BKE's capabilities. Similarly, Lucky brand dungarees dominated the top vendor spot for over a decade from 1992 to 2007. Finally, note the continued proliferation of the top brand list over the past 5 years, showing BKE's continued brand diversification. Buckle's merchandising strategy is different than other core youth retailers because Buckle sells branded products along with its private label. Buckle's private label is designed to complement its branded offering, but not intended to be a logo driven business. In addition, the company private label products generally earn a higher margin than branded products and have grown over the past 20 years. Thus, reductions in the private label mix would decrease the company's merchandise margins. We think this strategy has benefited the company significantly over the past few years for a few reasons. Number one, Buckle's assortment is easy to mix and match to create unique looks, which we think has helped the retailer compete with the new fast fashion players, e.g., H&M, Forever 21, Rue, etc. As well as steal market share from some of its less differentiated and more logo driven peers. We believe the takeaway is that young people, particularly women, do not want to dress in head to toe logo wear. Number two, the Buckle brand name is not readily apparent in Buckle's private label merchandise, thus allowing for broader market apparel appeal. The BKE brand today reaches a wider age demographic than it did even 4 or 5 years ago. While a 30-year-old customer might feel inappropriate wearing a top from Aeropostale, American Eagle, or Abercrombie and Fitch, we think some older shoppers find Buckle's products attractive and don't feel too old wearing them. These competitor retailers specifically target casual wear for consumers aged 22 or younger. Third, the private label offers many of the same trend and style elements featured in the branded product, but at low price points. This value proposition has helped and should continue to help the company in tough economic environments, demonstrated by gross margins remaining within 40 to 50% despite various recessionary periods. We believe the increase in private label as a percentage of total sales over the past 10 years has been quite beneficial to margins and should continue to help cushion margins against increases in labor and commodity prices. In addition, as private label penetration has increased, so has average unit pricing. We believe this is due to Buckle's unique in store customer selling strategy, which can guide guest purchasing. The company relies on its people, not expensive marketing or promotions, to sell its product and disseminate its brand message. The company's marketing expenses are lower than most 1% of sales versus mean of 2.1% of for a group of similar retailers. Abercrombie, American Eagle, Aeropostale, and Taylor, Chico's, Claire's, Gap Inc., Rue 21, and Urban Outfitters, due to its focused customer service. We believe that sales staff is trained to know apparel products better than the competition, which builds credibility and creates a unique shopping environment. The salespeople at Buckle team take the time to get to know the customers, which help them better recommend styles of denim or the right top to go with a specific bottom. The fact that most senior employees started as salespeople lay the foundation for Buckle's culture, which, in a volatile environment, can help stabilize BKE's ability to capture guest purchases. In addition to the company's successful loyalty program, the Primo Card, BKE offers its customers layaway free alterations and a private label credit card that accrues reward points. Still don't really see a mode except for them being in small communities. But if they're cheap enough, it still might be interesting. And it seems like good management. Salespeople are paid hourly plus 3% commission of all attributed sales. There's clear upward mobility within the company. Nearly the entire executive management team started in part-time sales, and the majority of BKE store area and district managers were once selling in BKE stores as well. Really like that. As a testament to the deep rooted culture at Buckle, its regional and district managers have an average of 34 years with the company, and around 50% of all store managers have been with BKE for over 3 years. BKE invests heavily in the education and development of its managers and store staff by hosting company wide meetings, small career meetings, and by creating educational videos and tools to increase productivity. Okay. We believe that this is BKE's competitive advantage or moat. A culture that not only understands fast fashion, but can also create an environment to suit each guest to maximize guest purchases. That's interesting because that is a mode that is harder to grasp, especially for one that for me who does not live in America and can't just go to one of their stores and yeah see it. It's not as easy to grasp. But it can be a mode, I guess. Not a really a mode, probably a competitive advantage, probably. Uh, yeah. Potential upside in continued store expansion. Another compelling positive for Buckle is that the company still has a long runway for store growth, particularly in underpenetrated markets. Buckle had 442 stores at July 31, 2022. Buckle has not opened more than 20 new stores per year since fiscal 2010 and has netted 9 new stores per year since fiscal 2000. We anticipate this trend remaining the same going forward. Like that. However, in terms of headroom for the concept, we believe the US could ultimately support well over 600 stores, but do not see management indulging in this type of growth. We do anticipate total domestic store potential in the low 500s over the next 10 years. But this number might rise toward the high 500s if Buckle continues to execute solidly on real estate and with its product assortment. Buckle currently only has stores in the US. Expansion beyond Canada could eventually be possible. But Buckle is conservative with growth plans. Like I said, I like that. So we do not expect any expansion outside of North America for the foreseeable future. New stores require approximately $1 million, 800,000 in capex with another 200,000 in inventory, net of payables. We estimate a first year ROI of around 50% with a 2-year payback. Damn. In addition to selective store expansion, BKE has embarked on an aggressive remodeling program since 2009. The full remodels are comparable to that of a new store in terms of capex and typically generate a 15 to 20% lift in sales. We believe that a majority of the store base is now in the newest format. Between 2006 and 2017, BKE digested some of the largest investments made in its history, e.g., DC, online fulfillment, improvements to website, infrastructure, and a large number of new stores and remodels. The total price for this revamp was $435 million, or 70% of all capex from 2000 through 2000, to 2021. We anticipate maintenance capex to be between $10 million to $20 million over the next couple of years. We believe that this focused store improvement plan was a big reason for BKE's increased SSS and margins over the last few years. As a result, we expect SSS to potentially normalize to low single digits over the next few years and revenue per square feet to stay around at $440. Key potential underpenetrated markets include the Northeast, 5% of stores, and the West, over 16% of stores. Key competitors, i.e., American Eagle, Express, Banana Republic, Hollister, etc. I have to read through them. All have greater than 500 stores. Potentially, if Buckle can find good locations in the Northeast, i.e., MA, NY, and NJ, and California, there's a chance that these stores. Oh, in the Northeast and California, I get it. And there's a chance. I was confused. I thought California in the Northeast. California is not in the Northeast. There's a chance that these stores, which would be located in densely populated market, could achieve higher sales productivity than the chain average. Online expansion. That's one point I was thinking about too. What about online? While BKE first launched its online store in April 1999, quite early, sales from this important channel have only recently become meaningful enough for management to call out. BKE has invested heavily in driving sales to its online stores over the past few years. Online sales have grown to 221 million for the 12 months ended April 30th, 2022, or 70% of sales. Buckle can continue to drive sales growth via e-commerce. Online sales at BKE have increased at a 50% CAGR from 2008 to today. We believe that BKE's online sales can contribute to over 20% to the top line over the next 2 or 3 years. But where is the moat there? There's none, right? Maybe the management still, but where's the moat there? Interestingly, digital. Why would I go there and not to like any other? Why wouldn't I buy on Amazon, for example? Interestingly, digital sales versus storefront sales have converged, NKA omni-channel by the industry within the industry. Investments in areas such as marketing campaigns, technology advancements, warehouse, fulfillment, etc., have generated demand for an omni-channel approach to retail operations, resulting in the industry trending to report store and digital sales, digital channel sales within one revenue figure. We believe there's a decent growth left in this channel for BKE. For example, before merging its online and store sales channels, Urban Outfitters had 40% of online sales. It is unclear how much longer Buckle will report separate digital sales, but it has grown its digital channel from 7.3% in fiscal 2011 to 17.1% of fiscal 2021. Wait, that's it? They don't write more about the online expansion? Okay. Because that's a big topic for me. But maybe I have to find out for myself. Large cash position and special dividends. Oh, yeah, I saw this. The company currently has cash equal to 35% of assets and 70% of market capitalization. We believe that this cash position should allow the company to continue grow or manage profitability. Buckle has issued a special dividends in each of the last 14 years. We think the Buckle is likely to continue to return cash to shareholders in this method, as the company has historically consistently favored dividends to buybacks. Oh, I don't like that. From 2000 to 2022, the company used $193 million, or 183 million from 2000 to 2008, for share buybacks, issued 1.5 billion and in $880 million in special or common dividends, totaling 2.6 billion in total distributions to investors over the last 22 years. 198 193 million from 2000 to 2022, and 183 million were from 2000 to 2008. So they didn't almost made no share buybacks in the recent time. But why, if they're so cheap? I don't like that. I don't like dividends. I'd rather have buybacks, especially when they're cheap. Or, I mean, when they're not cheap, they shouldn't do buybacks, but still. That is more than 1.5x the value of BKE current market capitalization. Assuming further special dividends of a smaller size to recent dividends could result in a dividend yield in the mid-single digit percentage range long terms. Good operating cash conversion. The company has brought down its cash conversion cycle, i.e., the net number of days it collects cash from operations, since pre-crisis. Part of the reason, we believe, for this is the company's ability to source fashionable inventory that can sell quickly. Another reason for improved cash conversion is that its growing online platform has been used as an inventory clearance tool. However, what strikes us the most as the most critical reason for improved cash conversion is that the company has been able to gain adequate scale to work with its vendors in determining appropriate and proper inventory for the latest fashion. BKE has managed to put itself in a select group of national retailers that run efficient cash conversion models below 60 days. In the most recent LTM period, BKE appears to have improved its cash conversion to below 40 days. Gift certificates cards have also grown 7% CAGR since 2005, which is another venue for quicker cash conversion in the business. Breakage, i.e., revenue gained by retailers through unredeemed, expired, or lost gift cards, has been materially small, meaning that customers' utilization is high. Compensation structure. Senior management is paid in base salary, cash bonus, and non-vested performance-based stock. The bonus pool is a cash incentive for executives. It is calculated each year by the compensation committee based upon dollars of growth in a key performance base year target amount, then multiplied by number one, the applicable established percentage set by the compensation committee and the previous fiscal year, and then multiplied again by number two, a factor determined by the increase above the previous year's base amount target. The base year target amount is the previous year pre-bonus net income. For example, in fiscal 2021, for part 1, 1.2% of fiscal 2021 pre-bonus net income. For part 2, its fiscal 2021 pre-bonus net income exceeded the company's target pre-bonus net income amount. Then a percentage of the amount above the target would be added to the base amount, calculating the total bonus pool. The bonus pool, computed in accordance with the 2021 Management Incentive Plan, resulted in a bonus pool of 16,133,509. Okay. Doesn't seem too high, but I actually, to be honest, I didn't quite understand how they calculate the compensation. I gotta reread that, but that doesn't seem too high. Non-vested stock is currently the only long-term performance-based component of the company's executive compensation program. The compensation committee determines the number of shares of non-vested stock granted to eligible executives. See Exhibit 20 for vesting eligibility of granted shares. Interestingly, the company achieved its primary performance objectives set to fiscal 2021 based on pre-bonus net income, and thus 100% of the shares granted to executive officers and others on January 31, 2021 were eligible for vesting. Although we believe that a return based incentive program is better long term for investors, we find this approach definitely acceptable as it allows the senior operating team to focus strictly on operating performance by increasing store productivity, product margins, and thereby absolute net income. Per share ROE or ROIC can then be managed through effective capital management. We believe that given the size of insider ownership, 40% of total shares, senior management has effectively executed capital management through the use of little to no debt and large dividends and share repurchases. Key named management executives' bios can be found in Exhibit 21. Exhibit 21. Let's see. Daniel J. Hirschfield, age 80. Mr. Hirschfield is the chairman of the board of the company. He has served as chairman of the board since April 19, 1991. Prior to that time, Mr. Hirschfield served as president and chief executive officer. Mr. Hirschfield has been involved in all aspects of the company's business, including the development of the company's management information systems. So he's a long. He's old, but he has long. I don't know if he. Yeah, he probably has a good track record. Yeah, I mean Buckle is at a good place, and he's probably part of the reason for that. Dennis H. Nelson, age 72. Mr. Nelson is president and chief executive officer and a director of the company. He has held the titles of president and director since April 19, 1991. Mr. Nelson was elected CEO on March 17, 1997. Mr. Nelson began his career within the company in 1970 as a part-time salesperson while he was attending Kearney State College, now the University of Nebraska Kearney. While attending college, he became involved in merchandising and sales supervision for the company. Upon graduating from college in 1973, Mr. Nelson became a full-time employee of the company, and he has worked in all phases of the company's operations since that date. Prior to his election as president and CEO on April 19, 1991, Mr. Nelson performed all of the functions normally associated with those positions. Thomas B. Heacock, age 44. Mr. Heacock is a senior vice president of finance, treasurer, chief financial officer, and a director of the company. He was elected a director on December 4th, 2017. Also, okay, so he's not that long in the company. Mr. Heacock was appointed, not as long as the others. Mr. Heacock was appointed senior vice president of finance, treasurer, and CFO effective February 4th, 2018, after having served as vice president of finance, treasurer, and CFO upon his appointment as CFO on July 2017. He has been employed by the company since October 2003. Okay. And served as vice president of finance, treasurer, and corporate controller prior to his appointment as CFO. Prior to joining the company, he was employed by Ernst & Young LLP. Mr. Heacock is the son-in-law of Dennis H. Nelson, who serves as president and CEO and a director of the Buckle. Okay, nepotism. No, I'm just kidding. Carrie G. Smith, age 58. Mrs. Smith is executive vice president of stores and a director of the company. She was elected a director effective February 4th, 2018, and was appointed executive vice president of stores on February 13, 2014, after having served as vice president of sales since May 2001. Mrs. Smith joined the company in May 1978 as a part-time salesperson. Later, she became store manager in Great Bend, Kansas, and then began working with other stores as an area manager. Mrs. Smith has continued to develop her involvement with the sales management team, helping with manager meetings and the development of new store managers, as well as providing support for store managers, area managers, and district managers. Okay, so long time there. Brad P. Milkey, age 62. Oh, they're all quite old. Now, okay, we got some 40-year-olds. Mr. Mulkey is Senior Vice President of Leasing. He was appointed to this position on March 6, 2014, after having served as Vice President of Leasing since May 1996. Mr. Mulkey was a leasing agent for National Retail Mall developer for 6 years prior to joining the company in January 1992 as Director of Leasing. Michelle M. Hoffman, age 60. Mrs. Hoffman is a Senior Vice President of Sales. She was appointed to this position on February 2022. February 22, 2022, after having served as Vice President of Sales since March 2014. Mrs. Hoffman has been employed by the company since 1979 and has served in various roles of increasing responsibility on the sales team since that time, including salesperson, store manager, district manager, and regional manager. Kelly Molczyk, age 43. Mr. Molczyk is a Senior Vice President of Women's Merchandising. Oh, Mrs. Molczyk. Oh, yeah, that makes more sense. Of Women's Merchandising. She was appointed to this position on February 22, 2022, after having served as Vice President of Women's Merchandising since December 2014. Mrs. Molczyk has been employed by the company since 1999 and has served in various roles on the women's merchandising team since that time, including Divisional Merchandise Manager. They all come up within the company. That's great. Brady M. Fritz, age 42. Mrs. Fritz is Senior Vice President, General Counsel, and Corporate Secretary. She was appointed to this position on February 22, 2022, after having served as Vice President, General Counsel, and Corporate Secretary since March 2021. Mrs. Fritz was hired by the company on December 10th, 2018, and has served as General Counsel and Corporate Secretary since that time. Prior to joining the company, she served Cargill Incorporated for over 10 years in several roles of increasing responsibility, including most recently as a global legal operations leader and senior attorney. Prior to joining Cargill Incorporated, Mrs. Fritz began her career at Scudder Law Firm in Lincoln, Nebraska. Okay, only one. It's not a long-time member of the company. Below is a historical compensation analysis for BKE's senior team. Cumulative compensation for management has been significant, particularly from Mr. Nelson, who received $75 million in compensation and most likely $120 million in shareholder distributions, $195 million total. So he has owned more than 5% of the stock since 2009. Wait, what? Dennis H. Nelson, salary about $1 million for each year. Oh, last in 2021 was oh no, never mind. About 1 million each year. Plus oh no, never mind. That's a base salary plus a bonus of around, well, let's say in some years only like 500,000, but in others 5 million. So I'd say an average of 2 million, maybe, or 1.5 million. Oh, plus a lot of stock. Yeah. Each year at least 1 million, but around 2 million on average. And plus other compensation 200,000. That's quite a big salary, isn't it? Yeah, here cumulative 74 million in 2021. Oh no, never mind. Cumulated from the beginning year. Okay, that's okay, but total salary per year is on average I'd say 4 million. No, more. 5-6 million. I mean, that's still okay. Dennis Beacock, total salary on average per year, or yearly average salary total, with salary, bonus, and stock and other, is around 1 million. No, less. I mean, 700,000, 800,000. That's all that much comparison. Karen B. Rhodes, CFO, retired in 2017. Around 1 million. Patricia K. Whistler, VP Women's Merchandising, retired 2016. Around 1 million as well. Kaylee D. Mokshich replaced Whistler, but not on proxy. Yeah, stays at 1 million. Oh, no, it's more. Almost 2 million. Brett P. Micheal, SVP, leasing, age 61, around 900,000, I'd say, or 800,000, 900,000. They all have a, wait, why is compensation going up for all of them in 2020 or 2021? Like crazy. Their base salary increases by 20%. Wait, is that correct? Yeah, 20%. And their, or maybe not 20%, but by a lot. And their bonus is crazy. From in 2019 it was 158, and before that around the same number, and then in 2020 it was 429, and 2021 is 1,400,000. How and why? Same goes for other. Before that, 170,000, 194,000, around that. Now 2020, 440,000 and 723,000 in 2021. And that goes for others too, right? Yeah, here, Thomas B. Hiccup. Before that, around 150,000 bonus, and now 2020, 429,000 and 1,411,000. Or let's just look at the total. Before that, around 700,000. Then 2020 it was 1.3 million, and 2021 2.6 million. Carl G. Smith, EVP store sales. Same goes there. Around 800,000 for the prior years. Oh, you know what? Never mind. They use go lower for Kerry G. Smith. For the others, it's the same. I looked at it wrong, I guess. Not for all others though, but I mean Thomas B. Heacock is still weird, but I think they just had a great year. They had greater compensation in the years prior to that as well, but then there were a few down years in terms of compensation. Now, okay. Negatives. Cyclical nature of fashion. The company's comparable store net sales results have fluctuated in the past and are expected to continue to fluctuate in the future. A variety of factors affect comparable store sales results, including changes in fashion trends, changes in the company's merchandising mix, calendar shifts of holiday periods, and actions by competitors, weather conditions, and a general economic conditions. With an understanding of the cyclical nature of fashion, BKE has always operated its business with a focus on maximizing long-term profitability for shareholders. Despite during fiscal years 2015 to 2016 and 2017, comparable store sales declined 4.4%, 13.5%, and 7.2%. BKE was able to manage its cash conversion and purchasing cycles to maintain both merchandise margin expansion. This period is considered as an industry-specific recession for U.S. retailers, as many U.S. retailers face similar margin pressures. Interestingly, BKE weathered this period far better than peers. This includes during COVID, where BKE not only saw productivity but margin expansion versus peers. Aging management, no clear transition leadership. President and CEO Dennis Nelson and Chairman Daniel Hirschfeld both to be in the twilight of their careers, despite exemplary careers. Nelson is 72 and Hirschfeld is 80, and both collectively own over 37% of their outstanding shares. It is worth noting that, but not a surprise, that Hirschfeld has sold over 25% of his shares since 2005, going from more than 50% to 33% controlled ownership. Although the board promotes talent from within, there's no clear management succession plan. And despite a top-class compensation program, management rewards its employees with cash, not stock. In fact, no executive outside Nelson and Hirschfeld owns more than 5%, 50 basis points, of the company's shares. There has always been an unspoken rule for changing managing compensation, both on Wall Street and in VC. Number one, pay employees more in stock bonuses in high growing revenue businesses to conserve and selectively target cash growth outlays. I mean, this is not a high growing revenue business. Number two, pay employees more in cash bonuses in little to no growth profitable businesses to preserve cash flow. Oh, okay. Yeah, that's more what it is. And dissuade outsiders from ruining a cash cow. We believe that carefully determining who gets shares can always keep a good cash machine and our growth going. Goldman Sachs is probably one of the few companies in the world that pays its best employees in stock to continue the owner manager mindset. No wonder it has maintained itself as the best financial firm in the world consistently since 1920 with very little argument otherwise. BKE's annual CEO letters pride itself on always operating the business with a focus on maximizing long-term profitability for our loyal shareholders. However, until a clear succession plan is laid out, we fear that BKE's shareholder-friendly days might come to an end in the next 10 years. At this point in the company's life cycle, it is critical that the board ensures not a transfer to younger executives. Unfortunately, without proper share ownership incentives, the cultural disruption might be imminent, and the board might be forced to recruit its next CEO, COO talent externally. One of the company's strongest investment themes has been its rare mix of owner managers who understand shareholder value. How unfortunate would it be then if this is not the most important item for shareholders over the next 5 years? But they did it before. Why wouldn't they be able to do it again? I mean, you could reward individuals with shares, right? When they become managers or hire managers like CFO or something. Hmm. Peak margins. I wonder if did the management say something about like the older management, like Dirk, what's his name, Hirschfield? Yes, Daniel Hirschfield and Dennis Nelson, about retiring. Like they said something. Did they mention it? The company has peak margins. The company has consistently grown margins throughout its history, despite the volatility in comparable store sales over the last 20 years. The company has built stores at a 6% CAGR while increasing productivity by 2% CAGR. As a result, margins have been steadily increasing despite the three global recessions. As of July 31, 2022, LTM EBIT margins came in at 25.2%. Trailing 5-year, 10-year, and 20-year EBIT margins are 17.5%, 19.4%, and 18.1%. Margins and store productivity are at an all-time high since 1992. BKE may have reached growth maturity in margins, or at the very least is at an operating performance plateau. The market, on the other hand, expects growth to slow as the company expands into new markets and as peaking margins and average unit retail price AUR make comp and margin growth tougher to achieve. As earnings growth slows, the market appears to see less room for stock appreciation than at faster growing specialty retailers, e.g., Lululemon, TJ Maxx, Ross Stores, and Dick's Sporting. Earnings outlook. As mentioned above, the company has been able to consistently improve store productivity and margins while holding store count growth steadily over the last 6 years. Operating margins currently stand at 25.2%. We believe most of the improvement has come in the form of the following efficiencies. Number one, increasing product margins by 1,340 basis points from 46.3% to 59.8%. Due to increased sales and private label items, online items, and increasing overall unit prices by $13 per item, Number two, lowering occupancy expense by 450 basis points from 13.6% to 9.1% of revenue due to effective real estate leasing management by Brett Mulkey and his team. This impact is a material gap occupancy expense increase due to adoption of new lease accounting topic 842. And third, keeping overhead costs of as a percentage of sales at 4%, most likely due to improved centralized purchasing, distribution, and call center functionalities. The majority of BKE's expenses are variable and move in tandem with sales due to a payout improved due to a payout structure largely focused on incentive comp and commission-based selling. This means that the company may not benefit from scale economies as other companies with larger amounts of fixed costs. The company pays its salespeople a base wage plus a commission, and managers earn a salary coupled with a percent of income generated by their stores, along with monthly and annual bonuses based on sales goals. See compensation section above. We believe that annual selling expenses will remain 18 to 20% of sales regardless of top line changes, and we forecast G&A expenses to be 3.9% of sales. We believe that management should be able to sustain EBIT margins of 18 to 20% over the next few years while growing top line modestly 6 to 8% per year. Given BKE's capital management prowess, we believe that ROAs should continue in the mid 20s to 30s. ROEs should be much higher. This should translate into similar increases in shareholder value, either in the form of dividends and or stock price appreciation. The company currently has nearly 100% dividend payout ratio. What? Dude, buy back. I don't know. Valuation. In order to appreciate BKE's valuation, an understanding of the retailer apparel subsector profitability and valuation dynamics are needed. We define the retail apparel sector in Exhibit 26. We believe that Buckle's peer group are big box retailers. Although BKE is one of smaller overall players within the group, although BKE should not be part these subsectors. Luxury and footwear should be used as ceiling and floor groups when comparing retail apparel. Profiling 484 publicly traded global retailers and vendors demonstrate that luxury brand retailers, e.g., Louis Vuitton, Hermes, Prada, Burberry, Christian Dior, Kering, Hugo Boss, Ferragamo, etc., not only command the top margins in the industry, but also have done so for the last 30 years. Not surprisingly, luxury retailers command the highest multiples as these franchises command a quality and emerging market penetration. The opposite is true for footwear retailers as a whole. However, BKE's margins perform in line with the top luxury retailers, i.e., Louis Vuitton and Christian Dior, having outperformed many of the top luxury brands in the world. In fact, within its category, it is the top performing company just ahead of Lululemon. Luxury retailers, okay, these are all the competitors. You might want to take a look at it, but I won't read through all of them. Now there are just a lot of graphs, which I won't read through. The majority of companies in the big box retailer group are retailers with recognizable private label branding. The average productivity for these retailers is $3 to $4 million per store. Not surprisingly, TJ Maxx, Ross Stores, Dick's Sporting, and Lululemon all have store productivity greater than $10 million per store. It is no wonder that BKE goes unnoticed by investors due to its underwhelming productivity, 1 million below other big box retailers, and no real growth prospects. Management does not allay those concerns either. It has been our experience that companies that command large and viable valuations are not just based on historical and expected performance, but mainly on expected growth. The more consistent a company's performance behaves with no growth prospects, the closer it can be valued using perpetuity growth valuations. Makes sense, since it behaves more like an annuity. Investors have a special portfolio uses for annuities and perpetuities, but have little tolerance to use significant investments in companies that do not grow. We believe that the market may be pricing BKE with anemic store growth, 5 store openings per year. This would suggest 25 new stores over the next 5 years, which is in line with BKE's latest growth performance. In addition, the market may be wary that BKE is at peak operating margins at 22.6%, when they have been as low as 14% 4 years ago and as high as 20% 10 years earlier. As a result, the market may be factoring operating margin compression to more historical average levels of 15% to 16%. Our analysis on retail store productivity has shown decreasing productivity for many retailers post the COVID-19 pandemic. In fact, many retailers have been closing key store venues to allay slowing store productivity trends, i.e., Gap, Abercrombie, Aeropostale, Claire's, Chico's, and Taylor Loft and American Eagle. We assume if mature, profitable retail stocks should trade at historical levels of 11x or greater, then the market is pricing BKE's valuation at around $36 per share. Despite our agreement with the market that that BKE should hit maturity over the next 5 years, given senior management's aging grip hold on the company's outlook, we are more realistic on fair valuation of the stock. Therefore, we assumed that the company will have hit maturity and saturated their target market by 2027. However, we do believe that management should be able to improve store productivity at its historical 20-year average of 4% per year to reach $3.5 million of net sales per store 2027. Next, we assume that it would cost the company approximately $30 million to build 25 new stores and $46 million to renovate and maintain its existing 442 stores over the same 5-year period. We assume that the company's internal cash flow from existing stores and new stores should help finance all the new store build and should not require additional debt or equity issuances. Our analysis comes out to an intrinsic value of approximately $50 per share, which would suggest a 51% premium to current stock levels. Remember, price at the point of funding is $40. I think now it is way lower. We'll take a look at that after reading. We therefore believe that the securities may be temporarily slightly mispriced. We believe that the current economic uncertainty in the general market may create opportunities to purchase the stock at levels significantly below current levels. However, current open option interest is heavily weighted to $50.50 strike calls, which may suggest that the market is more bullish than bearish on the stock. Nope, doesn't seem like it. Using sensitivity analysis on some of our key assumptions shows that we have a decent amount of room for upside in the security. We believe max fair value may be closer to 26% margins and a 14x PE, 10x EBIT multiple, or $70 per share. This would imply over 100% upside from current levels. Nevertheless, we are also mindful of the downside and would not be surprised if the market prices the security at 12% operating margins and then a 5x EBIT multiples. These assumptions would suggest a value of below $30 per share for BKE or more than 25% downside from current levels. Assuming no material changes in the fundamentals or the company, these latter assumptions may prove to be overly penalizing to a management and franchise with an excellent history of operating performance execution capabilities. Therefore, we believe a reasonable floor exists in the stock of no lower than $25 per share, at which point we would be heavy buyers of BKE, making it a significant position in our portfolio. Recommendation and rationale. The volatile nature of the markets and the earnings power potential for BKE is extremely attractive at current trading levels. We believe that BKE's stock is mispriced at current levels. As we have illustrated in this memo, BKE's historic ability to successfully execute its strategy despite the financial crisis is not only impressive, but also a testament to its unique positioning in the young adult fashion retail market. As a result, we recommend heavily purchasing the stock at or below $30 per share. Prices below should provide a significant margin of safety should the macroeconomic environment worsen for the retail space and or interest rates rise. BKA should also be able to raise AUR and increase productivity given its mode of a culture of fast fashion experts consultants who can significantly influence customer purchases. Catalyst. Continued improvement in SSS plus MSD digital comms and margins should create more favorable visibility in the stock and alleviate some of the investor skepticism. The continuation of strong dividend distribution coupled with strong return on equity on a per share basis should allow investors to benefit from BKE's historic ability to compound returns. Risks. There is a risk related to BKE's earnings outlook and stock price relative to the market expectations. Assuming no material changes in the operating fundamentals of the business, we view the potential of the market outlook to be negatively overfocused on SSS and EPS growth. Therefore, if SSS comms or SSF come in lighter, we would expect a short-term downward correction in the stock price. This would be amplified if there's further pressure in the macroeconomic environment on discretionary consumer spending. Currently, we view the market is overlooking the fact that company can generate strong returns on cash per share and effectively return cash to investors, especially if it turns out that BKE's growth prospects remain slower. Finally, uncertainty in aging senior management succession plans places a significant risk in the company's ability to maintain its shareholder-friendly strategy over the next 10 years. Ratings 1 to 10, 1 exceptional, 10 nonsensical absurdity. Value, intrinsic value over market value, 3.5. 3.5. Downside protection, low risk of permanent loss, 3.5. Management capable and properly incentivized, 1.5. Financial strength, a solid balance sheet, 1. Moat able to sustain high ROIC, 2. Okay, interesting. I don't know if I see that yet. Earnings momentum fundamentals improving, 3. Macro poised to benefit from econ secular trend, 1.5. Margin of safety, median of collection of above all metrics, 2. Catalyst continued improvements in SSS plus MSD digital comms and margins should create more favorable visibility in the stock and alleviate some of the investors' skepticism. The continuation of strong dividend distributions coupled with strong returns on equity on a per share basis should allow investors to benefit from BKE's historic ability to compound returns. Now we will quickly take a look. I have a call in 15 minutes. When we'll quickly take a look at BKE on Guru Focus. The Buckle Inc. Price is $42. Okay, it actually. Oh yeah, it was down. Oh yeah, it was below. God damn it, I missed it. But still interesting company. PE 8.42. Market cap. Market enterprise value is a little lower than the market cap. 2.08. Let's take a look. RE 62, RA 29, RIC 47, gross margin 50, operating margin 24, net margin 18. I like these. PE current 8.4, PB 4.9. Where do we have a current ratio to 11? That's also good. There. EV to FCF 10.56. Damn. I still like it. I don't know. Sorry for the shares buyback ratio. Wait, they're diluting shareholders? Why are they issuing more shares? Okay, I don't like that at all. They're not doing buybacks, but they're what? Wait, what? Why? But they're giving out a dividend? That's dumb. I don't know why that is, but I don't like it, and I find that weird. Okay, yeah, please tell me in the comments below what you think of this company. I still think it's very, 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 very interesting. But I have to dive further into it. I still do think it's very interesting. Maybe, like he said, not at the price, but I think whatever. Who knows? I don't yet, but I will inform myself more. And please tell me what you think if you have already informed yourself more, or even if not, just your opinion would mean a lot to me. Thank you very much.